I'm Darius McDermott of FundCalibre. Today I'm with Kevin Murphy, who's manager of the elite-rated Schroder Recovery Fund and the elite-rated Schroder Income funds. Kevin, you employ a recovery style of investing. Could you explain to our audience exactly what that means?
So when most people are in a chair like this talking about what they do, they talk about the great businesses they invest in. They talk about the wonderful barriers to entry, the pricing power, the dynamics and the growth. And the problem with that is that there's only a certain number of companies in the world that have those characteristics, and everyone is looking for them. So it means the prices get squeezed up higher and higher and higher to the level at which you're unlikely to make a good return from. So instead, we look totally the other way. We look deliberately for companies with problems. But importantly, we look for companies where the problems can be solved. Because it's only by looking at companies with problems, and they may have bad headlines, bad sentiment, negative news flow, downgrades, profit warnings. So only by looking at these companies you can get genuine bargains. And as those problems that those companies have get solved, the profits begin to improve and the valuation multiple improves as the stock market once again begins to fall in love with those companies. And the combination of the profits rising and the multiple increasing gives you some amazing long-term returns for our shareholders.
Value recovery investing had a difficult year in 2015, but historically it's been followed by strong returns. You've had a good start to this year. Do you think that it's likely to continue?
Well, that's the million-dollar question. I'm afraid I don't know the answer. You're absolutely right. So value investing has been proven around the world in every market it's been tested in, every academic study ever done, value works. So why doesn't everyone do it? And the answer is it doesn't work all the time. So traditionally, 1 year in every 3, it tends to underperform. Now, I'd like to say it's 1 year every 3, but sometimes it's 2 in 6, sometimes it's 3 in 9, and you don't quite know what it's going to look like. You're absolutely right. So 2007 was a tough year for us, and then 8 and 9 were both very good. 2011 was a tough year for us, and then 12 and 13 were very good. 2015 was a very, very tough year, and we hope what we've seen so far can be continued, but there's no guarantee about that. But what we would say is that if you can add to the fund when it's been bad, you should make some extraordinary long-term returns. So we use kind of events like 2007, 2011, 2015 as a marketing opportunity, not as a risk, and say to people if they have a long-term time horizon, 3 to 5 years, that it should be a tremendous time to be adding to the strategy.
The EU referendum is coming up. Is there anything you're doing differently in your portfolio? Any sectors or stocks that you're either avoiding or favouring at the moment?
So there is no doubt that the vote will have an impact on the portfolio. The problem is I don't know, I don't know what impact.
Which way the vote's going to
Exactly. So I think to answer the question, it's important to distinguish between risk and uncertainty, because the stock market deals with risk very, very well. So by risk, what I mean is where there's known outcomes. So a toss of a coin, a roulette wheel, things like that. The stock market is very, very good at pricing in, and it's very, very difficult to beat the market at that. So let's take an example. When the online gambling companies were forced to leave America, we went through and crunched our models, and it took us a little while, but within an hour or so we said, okay, so these are the right prices for the companies, and looked at the share prices on the screen. The stock market had already got there within 30 seconds. And you can't beat the market for things like that. If a pharmaceutical company, if a drug leaves the market, the stock market has already priced it in within 30 seconds. You can't risk. The stock market does very well. What the stock market doesn't do well is uncertainty. So what does the future of fixed line telecoms look in a mobile dominated world? Well, BT got down to 80p, it's now at 440 as that uncertainty has begun to be cleared. What is the outlook for banks in 2009? Well, Lloyd's got down to 25p. As the regulatory environment's improved, the share price has moved up to 70p. So we focus on where we do well best is areas of uncertainty. Brexit and the risk around it is either an in or an out vote. It's risk, but it's not uncertainty, and we just don't know which way it's going to go. And unless you have a very, very strong view as the likely outcome, you're not going to be able to beat the stock market, because the stock market's already started to price those things in. So what we're going to do in our portfolios is to focus on where there's greatest uncertainty and to buy the cheapest areas of the market with the negative headlines, the bad sentiment and the issues, and with the full knowledge that on a 3 to 5 year view, the outlook should be good for that kind of strategy.
Thank you, Kevin.
Not at all. Thank you.